A retired veteran in Ohio just lost $10,000. Not to a scammer, not to a bad investment, not to medical bills. He lost it to the United States federal government because of 2 bank deposits he made in the same week. Deposits from money he legally earned, money he already paid taxes on. And he had absolutely no idea he had done anything wrong until that IRS envelope arrived in his mailbox. This is not an isolated story. This is happening right now across America to retirees who spent their entire lives following every rule, paying every bill, and doing everything right. And the most alarming part, the part that should stop you cold, is that the trigger is not fraud. It is not tax evasion. It is not a crime of any kind. It is a simple, everyday bank transaction that millions of retirees make every single week, completely unaware that in 2026, that transaction is being watched, analyzed, and in some cases, penalized automatically by systems that never sleep and never make exceptions. Good evening and welcome to Global Updates 24. I'm your host, and tonight we are breaking down one of the most urgent and underreported financial threats facing American retirees in 2026. We have spent days researching this story, verifying the facts, and translating complex federal banking law into clear, actionable information that could protect your retirement savings starting tonight. If you are watching this for the first time, welcome. Please subscribe right now and hit the notification bell so you never miss a critical update like this one. Share this broadcast with every retiree you know, because what we are reporting tonight is information that most financial news outlets are simply not covering in enough depth. Like this video if you want us to continue bringing you stories that actually matter to your financial security. Now let us get straight to the facts. Tonight's top story. Federal banking enforcement has entered a new era in 2026, and American retirees are bearing the consequences. The United States government's financial monitoring infrastructure, long considered a background function of the banking system, has been significantly upgraded and is now operating with a level of speed, automation, and precision that has no historical precedent. Transactions that once passed through the system without a second glance are now being cross-referenced, pattern analyzed, and flagged within seconds. And at the center of this enforcement shift is a federal law that has existed for decades, but is now being applied with the kind of efficiency that is catching ordinary Americans completely off guard. Here is what every retiree in America needs to understand tonight. Under the Bank Secrecy Act, a law passed in 1970 and updated numerous times since, every financial institution in the United States is legally required to file what is known as a currency transaction report, commonly referred to as a CTR. Every single time a customer conducts a cash transaction exceeding $10,000. This applies to cash deposits, cash withdrawals, and certain types of cash transfers. The filing requirement is automatic. The customer does not initiate it. The customer does not sign it. In many cases, the customer never even knows it happened. The bank handles it entirely behind the scenes as a matter of federal compliance. For most of the decades since this law was enacted, these reports were filed, stored, and largely dormant, unless a human investigator had a specific reason to examine them. The system existed, but enforcement depended heavily on human bandwidth. Investigators, auditors, case reviewers, who could only process so many reports at a given time. That limitation created, in practical terms, a significant gap between what was being reported and what was actually being scrutinized. That gap has now been closed. In 2026, currency transaction reports are no longer entering a passive archive. They are being fed directly into sophisticated, automated analytical systems that immediately compare them against a retiree's tax return history, Social Security income records, pension distribution records, and other officially reported financial data. These systems do not take breaks. They do not have backlogs in the traditional sense. They operate continuously. And when they detect a discrepancy between what a person is depositing and what that person has officially reported as income or financial activity, they generate a flag. Instantly, automatically, and without any human intervention, required before that process begins. What does this mean in practical, real-world terms for the average American retiree? It means that a large cash deposit, even one that is entirely legitimate, entirely legal, and connected to a completely ordinary life event, can now generate automated scrutiny if it does not align cleanly with the data the government already has on file. Sold your truck for $15,000 in cash? Received $20,000 from a family member to help with medical expenses? Took a lump sum pension distribution? Transferred a large amount between your own accounts to fund a major purchase? All of those are normal. All of those are legal. But if the financial picture in your government records does not immediately and clearly reflect those events, the automated system does not know that. It sees numbers, it sees patterns, and it asks one relentless question: does this match what has been reported? But tonight, our report goes deeper than the CTR itself, because the most dangerous threat to retirees is not the currency transaction report. It is the federal violation that well-meaning, law-abiding people accidentally commit while trying to avoid it. Federal law enforcement officials and financial compliance experts have identified a growing pattern in 2026. Retirees unknowingly engaging in what federal law defines as structuring. And structuring, not large deposits, not unreported income, but the specific act of breaking up transactions to avoid the reporting threshold, carries penalties that begin at $10,000 per violation and can escalate significantly from there. Here is exactly how structuring happens in the real world and why it is so easy to stumble into without realizing it. A retiree has $12,000 in cash. The source is entirely legitimate: the sale of a personal vehicle, savings accumulated over time, a gift from an adult child. They walk into their bank, and before they reach the counter, they remember hearing somewhere that banks report transactions over $10,000 to the government. They are not trying to hide anything. They are not attempting fraud. They simply do not want government paperwork filed on their account. So they make what feels like a reasonable decision. Deposit $8,000 today, come back 2 days later, and deposit the remaining $4,000. 2 transactions, both under the threshold, no report filed. Seems cautious, seems smart. It is, under federal law, a structural violation. Structuring is defined as the deliberate division of a cash transaction into smaller amounts for the explicit purpose of evading the currency transaction report requirement. And here is the element of this law that shocks almost everyone who hears it for the first time. The legality of the underlying money is completely irrelevant to the violation. It does not matter that the cash came from a legitimate sale. It does not matter that every dollar has already been taxed. It does not matter that the retiree has no criminal history and no intent to defraud anyone. The violation is not about where the money came from. The violation is the act of structuring the deposits to avoid the reporting trigger. That act alone, regardless of the source, regardless of the intent, in the traditional sense, constitutes a federal offense under 31 U.S.C. Section 5324. The automated systems now embedded in the banking infrastructure are specifically calibrated to detect structuring patterns. They analyze deposit timing. They analyze amounts in sequence. They analyze the relationship between transactions over days and weeks. When two or more deposits appear to be deliberately coordinated to remain beneath the $10,000 reporting threshold, the system flags the pattern, not the individual transaction, but the pattern across transactions. And once that flag is generated, the consequences can move quickly. The painful irony documented in case after case is this: retirees who deposit a single large sum of legitimate cash face nothing more than a routine CTR filing. No penalty, no investigation, no disruption to their lives. But retirees who split that same deposit into smaller amounts to avoid the report find themselves flagged, questioned, and in some cases penalized, not for having the money, but for how they attempted to deposit it. Tonight, Global Updates 24 is bringing you the 3 protective measures that financial compliance experts and tax professionals say every retiree should implement immediately. First and most critically, never structure deposits. If you have legitimate cash exceeding $10,000, deposit it in a single transaction. Allow the bank to file the currency transaction report. That report is routine, it is expected, and in the overwhelming majority of cases involving legal funds, it leads to absolutely nothing further. The report itself is not the danger. Attempting to avoid it is. Second, build and maintain a documentation trail for every significant financial event in your life. Sell a vehicle, obtain a signed bill of sale, and keep a copy in a secure location. Receive a large gift from a family member. Request a written gift letter specifying the amount and the nature of the transfer. Receive a pension distribution. Preserve all associated paperwork. Make a major cash purchase. Retain all receipts and invoices. These documents are not bureaucratic formalities. In the context of automated financial enforcement, they are the evidence that gives context to numbers that would otherwise appear as unexplained anomalies in your account history. When your records are complete and organized, you have answers before the questions are ever asked. Third, if your financial situation involves complexity beyond standard Social Security income and a straightforward pension, if you have received large gifts, sold property, taken distributions, or moved significant sums between accounts, consult with a qualified CPA this year. Not simply to file your taxes, but to ensure that the story your tax return tells is complete, accurate, and consistent with the financial activity reflected in your bank records. Automation does not penalize large deposits. It flags inconsistencies between reported financial history and actual financial activity. A knowledgeable tax professional helps close those gaps before the automated system identifies them. Before we close tonight's report, there is a broader context that every viewer needs to understand. The enforcement infrastructure changes of 2026 are not temporary. They are not a seasonal crackdown or a short-term initiative. They represent a fundamental and permanent shift in how financial compliance oversight functions in the United States. The integration of automated analysis, real-time cross-referencing, and machine pattern detection into the banking compliance system is an institutional change, one that reflects where financial oversight is headed, not just this year, but for the foreseeable future. The retirees who are most at risk in this environment are not those with complicated financial histories or questionable activities. They are the ones carrying outdated assumptions, the belief that keeping transactions small was a sign of caution, that staying below certain thresholds was simply being private, that what the government did not immediately notice did not matter. Those assumptions were always legally questionable. In 2026, they are actively dangerous. The mindset that protects you now is not secrecy. It is not avoidance. It is not staying under any threshold. The mindset that protects you is transparency, supported by documentation. A clear, organized, well-documented financial life gives automated systems nothing to question and nothing to flag. That is not just compliance advice. That is the most practical form of financial self-defense available to American retirees today. You built your retirement through decades of discipline, sacrifice, and careful decision-making. Protecting it now requires the same discipline, not complicated strategies, not expensive legal maneuvers, just accurate information applied consistently and clearly. That is our report for tonight. This has been Global Updates 24, bringing you the financial news that directly impacts your life and your security. If this report gave you information you did not have before, please take 10 seconds right now and share this video on Facebook, with family, in your community groups, anywhere retirees in your life might see it. A single share could protect someone you care about from a $10,000 penalty they never saw coming. Hit that like button to help this information reach more people. Drop your questions or comments below, and our team reads every one. And if you are not yet subscribed, subscribe now and turn on notifications. We publish financial news and retirement protection reporting every week, and you do not want to miss what is coming next. Stay informed, stay protected, and we will see you in our next report right here on Global Updates 24.